IFRS 13 Fair Value. IFRS 13 defines fair value as the price that would be received to sell an asset, or paid to transfer a liability in an orderly transaction between market participants at the measurement date. That price would be described as the exit price. The market-based current exit price implies an exchange between unrelated, knowledgeable, and willing parties. Fair value is a market-based measurement, not an entity-specific measurement. It focuses on exit prices of assets and liabilities and takes into account market conditions at the measurement date. Because it's a market-based measurement, fair value is measured using the assumptions that market participants would use when pricing the asset, taking into account any relevant characteristics of the asset. The transactions take place either at the principal market for the asset or liability, or in the absence of the principal market, in the most advantageous market for the asset or liability. The principal market is the market which is the most liquid for that asset or liability. In most cases, the principal market and the most advantageous market are the same. Fair value is not adjusted for transaction costs, as these are not a feature of the asset or liability, but may be taken into account when determining the most advantageous market. For non-financial assets, the fair value measurement looks at how the asset can be used. It takes into account the ability of a market participant to generate economic benefits by using the asset in its highest and best use. Fair value measurement of a liability assumes that the liability is transferred at the measurement date to a market participant who is then obliged to fulfill the obligation. Valuation techniques. The standard establishes three-level hierarchy for the inputs that valuation techniques use to measure fair value. Level 1. Quoted prices in active markets for identical assets or liabilities that the proportion entity can access at the measurement date. Level 2. Inputs other than quoted prices included in Level 1 that are observable for the asset or liability. Level 3. Observable inputs for the asset or liability. Valuation approaches. There are three valuation approaches. A income approach. Valuation techniques that convert future amounts to a single current amount. B. Market approach. Valuation technique that uses prices and other relevant information generated by market transactions. C. Cost approach. Valuation technique that reflect the amount that would be required currently to replace the service capacity of an asset. Entities may use more than one valuation technique to measure fair value in a given situation.